Japan has more millionaires per capita than most countries, yet their average salary is lower than the West. Today, I'm revealing the 400-year-old investment rule that's making ordinary Japanese people extraordinarily rich. Meet Hiroshi, a 45-year-old Tokyo office worker who never earned more than $50,000 per year. Last month, his investment portfolio hit $2.3 million. His secret? A Japanese investment principle called nagaime, literally meaning long eyes, combined with what they call the compound patience strategy. But here's what's fascinating. Hiroshi didn't pick winning stocks, time the market, or get lucky with crypto. He followed a systematic approach that's been used in Japan for centuries, originally developed by rice merchants in the Edo period. The Japanese investment rule is built on three core principles that go against everything Western finance teaches: consistency over brilliance, time over timing, and boring over exciting. While Western investors try to beat the market, Japanese investors focus on something much more powerful, letting the market work for them through systematic long-term wealth building. What makes this approach revolutionary is that it's designed for ordinary people with ordinary incomes. You don't need to be a financial genius or have insider knowledge. You just need to understand how compound interest works when combined with Japanese discipline. The core of Japanese wealth building follows what they call the Ichiman rule, named after the 10,000 yen note. Here's how it works. Rule 1. Invest the same amount every month regardless of market conditions. Hiroshi invested exactly 50,000 yen, or $375 every single month for 20 years. Not 40,000 one month and 60,000 the next, exactly 50,000 yen, whether the market was crashing or soaring. This is called dollar cost averaging in the West, but the Japanese perfected it centuries ago. Rule 2. Focus on dividend-growing companies, not growth stocks. Instead of chasing the next Toyota or Sony, Hiroshi invested in companies that consistently increased their dividend payments year after year. His portfolio included boring businesses like utilities, consumer goods, and real estate, companies that pay shareholders reliably regardless of market conditions. Rule 3. Reinvest every dividend automatically. This is where the magic happens. Every dividend payment immediately bought more shares, which generated more dividends, which bought more shares. The Japanese call this fukuri no chikara, the power of compound interest. Rule 4. Never sell during market crashes. When the market dropped 40% in 2008, Hiroshi didn't panic. When COVID crashed markets in 2020, he kept investing. The Japanese understand that market crashes are sales events, opportunities to buy quality companies at discount prices. The beauty of this system is its simplicity. No complex analysis, no market timing, no emotional decisions, just systematic, patient wealth building that compounds over decades. Here's exactly how Hiroshi structured his investments using the Japanese approach. 40% Japanese dividend aristocrats, companies like Kao Corporation, KDDI, and Japanese Tobacco, businesses that increase dividends for 10 plus consecutive years. These provide stability and steady income growth, typically yielding 2 to 4% with annual dividend increases of 5 to 8%. 30% global dividend champions, international companies like Coca-Cola, Johnson & Johnson, and Nestle. The Japanese understand that true wealth requires global diversification. These companies have paid dividends for 50 plus years and operate in every economic condition. 20% real estate investment trusts, REITs. Japanese REITs focusing on office buildings, shopping centers, and logistics facilities. REITs are required by law to pay out 90% of their income as dividends, providing higher yields of 4 to 6% with monthly or quarterly payments. 10% high-quality bonds, government and corporate bonds for stability during market volatility, not for growth, but for peace of mind and portfolio balance during economic uncertainty. The key insight: Hiroshi wasn't trying to get rich quick. He was building a portfolio of assets that would pay him increasing amounts of money every year for the rest of his life. His average portfolio yield started at 3.2%, but grew to over 6% on his original investments as companies increased their dividends year after year. Here's where the Japanese rule becomes truly powerful. Let me show you Hiroshi's actual progression. Years 1 to 5, investing $375 a month income, $22,500 total invested. Portfolio value, $28,400. Annual dividend income, $912. The foundation years, building the base while learning patience. Years 6 through 10, total invested, $45,000. Portfolio value, $73,200. Annual dividend income, $2,928. The acceleration begins. Dividends buying meaningful amounts of new shares. Years 11 through 15, total invested, $67,500. Portfolio value, $156,800. Annual dividend income, $7,840. The tipping point, dividend income exceeds annual contributions. Years 16 to 20, total invested, $90,000. Portfolio value, $287,600. Annual dividend income, $17,256. The compound explosion, wealth building becomes unstoppable. But here's the most incredible part. By year 25, Hiroshi's portfolio was worth over $450,000 and generating $25,000 in annual dividend income. He had invested $112,500 on his own money, but compound interest had created an additional $337,500 in wealth. The Japanese understand something most Western investors miss. Time is more powerful than money. Hiroshi's modest $375 monthly investment became a fortune, not because he was brilliant, but because he was consistent and patient. What makes the Japanese investment rule so effective isn't just the mathematics, it's the psychology. The system is designed to work with human nature, not against it. Removes emotional decision-making. By investing the same amount every month, regardless of market conditions, you eliminate the fear and greed that destroys most investors. You buy more shares when prices are low, fewer when prices are high, automatically optimizing your returns. Creates positive feedback loops. Watching your dividend income grow every quarter provides psychological reinforcement. Unlike growth stocks, where you only profit when you sell, dividends pay you to hold quality companies. Builds wealth gradually. The Japanese approach prevents the boom-bust cycles that plague Western investors. No massive gains followed by devastating losses, just steady, predictable wealth building. Focus on control. You can't control market returns, but you can control how much you invest and how consistently you invest it. The Japanese rule focuses entirely on what you can control. The Japanese have a saying, the best time to plant a tree was 20 years ago. The second best time is now. This philosophy perfectly captures their approach to investing. It's never too late to start, but the sooner you begin, the more powerful the results. Here's how to implement the Japanese investment rule starting today. Step 1. Calculate your monthly investment amount. Take 20% off your after-tax income. If you earn $4,000 monthly, that's $800. Start with whatever you can afford, but commit to the same amount every month. Step 2. Set up automatic investing. Use a brokerage that allows automatic monthly investments. Set it up so the money is invested before you even see it, removing the temptation to spend it elsewhere. Step 3. Build your core portfolio. Start with broad dividend-focused ETFs like YVM, Vanguard High Dividend Yield, or SCHD, Schwab US Dividend Equity. These give you instant diversification across hundreds of dividend-paying companies. Step 4. Enable dividend reinvestment. Set up DRIP, dividend reinvestment plans, so every dividend automatically buys more shares. This is where the compound magic happens. Your dividends buying more dividend-paying assets. Step 5. Ignore market noise. Don't check your portfolio daily. Don't panic during crashes. Don't get excited during bull markets. The Japanese rule works because you stick to it, regardless of market conditions. Step 6. Track your progress annually. Once per year, calculate your total dividend income and portfolio value. Watching these numbers grow provides motivation to continue the system. Let's be honest about what this strategy requires and delivers. Time requirements. This isn't a get-rich-quick scheme. Real wealth building takes 15 to 20 years, but the Japanese understand that those years will pass anyway. You can either spend them building wealth or wishing you had started earlier. Discipline requirement. You must invest consistently, especially during market crashes when every instinct tells you to stop. The Japanese succeed because they view the market volatility as opportunity, not threat. Return expectations. Don't expect 50% annual returns. The Japanese rule typically generates 8 to 12% annual returns over long periods. Not exciting, but incredibly powerful when compounded over decades. Lifestyle impact. You'll need to live below your means to fund consistent investing, but the Japanese prove that modest sacrifices today create extraordinary freedom tomorrow. The Japanese investment rule works because it's boring, systematic, and patient. While others chase excitement, the Japanese build wealth through consistency and time. He is now 50, and his portfolio generates more dividend income than his salary. He's not retired, but he has something more valuable than money: complete financial freedom and peace of mind. The Japanese investment rule isn't about getting rich overnight. It's about getting rich inevitably. It's about understanding that wealth isn't built through brilliant stock picks or perfect timing. It's built through systematic investing and the patience to let compound interest work its magic. You have a choice. Spend the next 20 years hoping for financial miracles, or spend them following a proven system that's created wealth for centuries. The Japanese figured out long ago that the secret to investment success isn't complexity, it's consistency. If this changed how you think about building wealth, hit that like button and subscribe for more time-tested investment strategies. Drop a comment. Are you ready to start thinking about investing like the Japanese? Thanks for watching. And remember, the best investment strategy is the one you can stick with for decades.